Evening, ladies and gentlemen. My name is Benjamin Goh. I will be your presenter for this evening's presentation. This is basically the 5 things that you want to keep an eye out when you're doing your investing. So just give me a second. I need to toggle my PowerPoint slides to make sure it's working properly. Okay. So the agenda for today is basically the 5 steps to successful investing. None of it is going to be rocket science, and obviously we're not going to be talking about any particular stock or strategy per se, but it's really about some rules for the road. Okay, and we'll be talking for maybe about half an hour to 40 minutes, and then after that we'll leave the rest of the session open to questions. So if you do have questions, please post it to our Facebook page so that the events team can send it to me, and then I can answer your question. All right. So before we begin, just a disclaimer, a caveat that whatever we're going to discuss this evening is basically an opinion. It is not a recommendation or cannot be misconstrued as any kind of professional opinion. All right, so before you execute any kind of action on the stock market, please do consult a licensed professional, so your financial planner, your fund manager, or your broker, or whoever that is licensed by MAS. Okay, so let's talk about the 5 things. So the first thing would be let's talk about the role of inflation, and let me just hide this thing. Okay, inflation. Now, as you can see, we have Singapore inflation for the last 5 years. The information, you can find it from this website called tradingeconomics.com. This is a free website that has got a lot of economic statistics for many countries, globally speaking. Most of it is free, so obviously if you want to have more detailed information, you have to be a subscriber, but most of it is free. Trading Economics, and my understanding is that Trading Economics got it from the statistics of Singapore. All right, so it's probably going to be the same information if you get it from a Singapore government website. So back to the data, we do have the Singapore inflation for the last 5 years, and as you can see, the last 5 years we went through a couple of things. So obviously in 2020, inflation would have been down simply because of the COVID-19 pandemic. But if you were to look at the data from, let's say, 2017 to the year 2020, so the last 3 years, you'll see that the inflation is kind of hovering between 0 and close to 1.5. So inflation of 0 is probably too low, close to 1.5 is probably too high. So as you can see, the average or the median inflation is about 0.5%. Okay. Now, of course, the question that you may have is, how does that affect, or how does that compare to the savings account interest rate that you are going to earn if you put inside a bank? All right. The actual savings account interest rate can vary from between 0.05% to 0.25%. So that really depends on the account type as well as the amount of monthly deposits. So for example, if you go to, let's say, POSB, you open a standard save as you earn account, the more money that you put inside your account and deposit there, you're going to get a higher interest. All right. What you can see on the chart here is again from tradingeconomics.com. This is more like a blended rate. All right, so they kind of look at all the different savings account and then they come out with some kind of average. So it's not going to be exactly what you will see from a bank website. But again, we know that the actual interest rate is between 0.05% to 0.25%. Okay, now let's look at the high end. Okay, before we talk about the high end, let's look at the chart. All right, so for the last 5 years, the interest rate that you can get from a bank, and this is again a blended rate, not the actual rate, is the high point is about 0.25%, and the low point is about 0.13%. Okay, let's just be charitable and be generous, and we say that we can actually get the maximum 0.25% interest rate. All right, so just hold that thought for a minute. 0.25% interest rate you can get from a bank savings account. But if you go back to the previous slide, as you can see, the rate of inflation for Singapore is kind of about 0.5% prior to the COVID-19 pandemic. So 0.5% inflation versus the interest rate that you get in savings account, 0.25%. So as you can see, inflation is far higher than the interest rate that you can get from a standard bank account. Okay. All right. So let's zoom out a little bit. Let's look at the last 25 years then. Maybe the last 5 years is not a good gauge because of what's been happening globally speaking. But let's look at the last 25 years of the Singapore inflation. So this is from the year, I think 1996 or something, all the way to now, 2021. So as you can see, it in the years 2007, 2008, 2009, it kind of went really berserk, almost 8%. So that was a time when everything was expensive, and most of us living in Singapore were complaining about high inflation. But obviously, after 2008, 2009, we had a great financial crisis, and the inflation dropped. All right. But if you just draw a straight line, you can see that the inflation rate can be very high, can be very low, but it kind of is about 1%, right? If you just draw that line, 1%, it looks kind of right to kind of even out the highs and the lows. So again, we can take that as a rule of thumb. The last 25%, inflation is about 1%. Now let's look at the savings account interest rate for the last 25 years. So as you can see, prior to the year 2000, interest rate was pretty high. And of course, it went down quite a fair bit. And of course, now it's, as you can see, it hovers between 0.05% to 0.25%. All right. And obviously, even if you look at this chart here, you can see that the interest rates, from the year 2002 onwards, have been lower than the rate of inflation, which we have just discussed, which is at 1%. All right. So the net is that the longer that you put money in a bank savings account, your money is actually not growing in line with the rate of inflation. Inflation is far higher compared to what you can get from a bank. And even if you max out your monthly deposits, you're gonna stop at 0.25%, while inflation is at 0.5% or at 1%, so on and so forth. Okay. Now, obviously, that is not true for the year 2020, simply because of the COVID-19 pandemic, but it is not a normal year. So when things get back to normal, you're gonna have an inflation which is about 0.5% to 1%, which is still higher than the rate of interest. So the problem here is that your money is not keeping up with the rate of inflation. So as time goes by, you are going to have, or rather your money is going to be worth less and less. All right. Now, one way of getting past that, and I suppose the most accessible way for retail investors, is really to invest in the stock market. All right. So I have a comparison here. This is again for the last, or rather since the year 1999 to the year 2021. This is the maximum I can have for this particular chart here. And this chart is from a free website called the stockcharts.com. And because this is a free website, I did not pay for it. So the maximum I can zoom out is about, since January 1999. All right, so not exactly 25 years, but more than 20 years. So it's quite representative. So you can see the red color line, which is the STI index, and the blue color line, which is the S&P 500. Now, this kind of chart is not a standard price chart. This is what you call a performance chart. So if you look on the right-hand side, you don't see dollar values or points. You can see percentages, right? So how you read this is that if you look at the start date is 4th of January 1999, that will be 0%. So if the value of the STI index is above, then of course you're going to have positive percentages. If it's below, then it's going to have negative percentages. So obviously at the end of this chart, you want to have a number, a percentage which is as high as possible. If you look at the red color line all the way to the right hand side, you can see that it is maybe about 116%. right? So it's above 110%, maybe 116%. So which means that if you have bought into the STI index and you held it for the last 22 years, you would have doubled your money, or slightly more than doubled your money. If you look at the blue color line, which is the S&P 500, if you have simply bought the S&P 500 ETF, you would have tripled your money, right? So $10 would have become $30 because the rate of return is 200%, all right? Now, obviously, this is over a span of 22 years, and what you can do, or what we can do, is to recalculate it so that we can see the performance on a per annum basis. And how we can do that is simply to calculate the cumulative annual growth rate, CAGR. So there's a standard formula which you can just look up on, the internet, just Google it. So, for example, the STI index performance was 110% over 22 years. If we recalculate the CAGR, that will work out to be about 3.4%, per year for the last 22 years. And for the S&P 500, that would have been 5.2% every year for the last 22 years. Now, obviously, this is far better than the rate of inflation in Singapore, which again, it's about 1% for the last 25 years. So this is kind of the way in which you can beat inflation in Singapore, because obviously, if you put your money in a bank, you are actually losing the value every year. All right. Now, what you can see is, of course, this is not a straight line. The benefit of putting money in a bank just to earn interest is that, it's quite stable, right? So you have got interest rates going up, going down, but you're not going to have negative interest rate. That means you can't actually lose money. It's just that you will make less money. But obviously, if you invest in the stock market, it is possible to have negative returns. So take, for example, the S&P 500. As you can see, there are some years, notably between the year 2001 to 2006, the middle of 2006, the S&P 500 was actually underwater because it is below the zero line. And as well as between 2008 to 2010, again, it is below the zero line. So it is possible to lose money. All right. So that is basically the trade-off between putting money in a bank versus the stock market. But if you think about it, you really have got, in a way, you don't have any choice. Because if you put money in a bank, you will definitely lose money over time. The value of your dollar will be worth less and less every year. Okay. So although there is volatility in the stock market, you do make a lot more money over time. Now, this is especially important for young people, which we're going to talk about in a minute, because young people have got many years in front of them to, compound their returns on the stock market. All right. Now, coming back to this chart, so of course, one way to kind of mitigate the volatility in the stock market is to basically diversify, right? So buy a little bit of everything. Okay, and before we go on, let me just go back to the last slide here, the Singapore inflation. Now, this is the general rate of inflation. That means it's for the entire economy. But again, just for the sake of sharing, there are two sectors which generally have got price increases greater than the rate of inflation. The first one is education. Generally speaking, price increases for education or education products tend to go up higher than the rate of inflation. And the second one will be healthcare. Yeah, healthcare. Now, if you think about it, these are two things that you can't get away with. So if you do have children, you need to pay for education. Now, Singapore university education and polytechnic education, secondary schools, so on and so forth, are highly subsidized, right? So that's not a big problem. But obviously, if you want to send your child for, let's say, NUS, medical school and all that, it is going to be quite expensive. Obviously, if you send your child overseas, Australia, UK, or the US for tertiary education, that is going to be even worse. All right. So as you can see, education tends to run ahead of inflation. And the second one is, again, healthcare. So healthcare is getting more expensive over time and is definitely increasing at a rate faster than inflation. Again, healthcare in Singapore is highly subsidized, especially if you're a citizen. But, if you touch wood, have any kind of serious illnesses, there's going to be a big chunk of change, right? So, these two are the sectors which, unfortunately, everybody needs to buy services from. And these are the two sectors which generally run ahead of inflation. So that's a point to note, right? So I know it sucks to get old, but everybody gets old, and everybody will have to, go and see a doctor or end up in hospital once in a while. So that is actually quite important to note, right? Things are going to get a lot more expensive, especially for healthcare as well as education over time. All right, so what is the net here? The investing point that we want to make is that the bank savings account, the interest rate that you get from that kind of account, simply cannot keep up with the inflation. And again, as I alluded to just now, every year your savings are worth less and less. So obviously the interest rate is there, but the rate of inflation will be higher. And one way to kind of be able to square this circle is really to invest your savings. Now, there are a couple of ways of doing it. Even for, let's say, a bank like DBS or OCB's, DBS or POSB, they do have products such as a regular savings plan. All right, so you can basically dedicate a fixed amount of money. So every month you'll take the money out of your savings account and then buy it into a ETF or a stock that you have, told them to buy. So that's kind of like a mandatory saving. So it's a little bit like CPF, but it's voluntary and you can stop it anytime. So that's the kind of product is actually quite useful because you don't really have to think about it. Simply automatically invest your fixed sum of money for you. All right. So if you don't like that, then of course you can manually invest. All right. Then of course the trade-off is that the stock market is not one straight line. It is possible to lose money. Especially in times like this. Even last night, the S&P 500 dropped about almost 3% on no news. So simply because people are a bit edgy about the vaccination campaign in the US faltering and not enough vaccines being supplied. But of course, the companies itself, like Facebook and Apple, they actually have got very good earnings for 4Q, but the market simply didn't like it, and the market sentiment went down. So you've got a whipsaw. So can't really explain why, but as you can see, sometimes the market can be a bit irrational and unexplainable. So this is volatility for you, right? So there is a trade-off. Now, the second point that we want to discuss is related to what we're talking about. So diversification. Now, diversification simply means you don't want to buy too much of the same thing, right? Think of it this way. If you, go to a restaurant and you order fried rice, and, the fried rice comes and you eat it and you don't like it, well, too bad, because you only ordered one thing, right? But if you go to, let's say, a buffet, they've got so many things. They've got fried rice, they got chicken, they got beef, they got what have you. So if the rice doesn't taste good, well, at least there's the steak, there is the noodles or whatever you have in a buffet. So I would like to kind of equate diversification to going to a buffet, because you've got so many selections, and because you already paid the price, you can choose anything that you want. So if one particular dish doesn't taste good, there are other dishes. All right. So coming back to investments, what we mean is, let's not just buy one thing. You can buy a few different things, so that even if one particular stock goes down, it is unlikely that all stocks in your portfolio will drop at the same time if it is properly diversified. So just to give you an example, let's look at the STI index again. This one will be the red color line, right? So as you can see, this is the numbers at the end on the right hand side for the red color line is again slightly north of 110%. So the numbers are actually the same as the previous chart. But in this chart, I've also included the green color line, which is Disney, and the blue color line, which is General Electric. So I've just randomly chosen a couple of well-known names. Disney, obviously, is, they have got the Marvel superhero movies, they've got Indiana Jones, Star Wars, they've got the theme parks, the cartoons, the toys, so on and so forth. And of course, General Electric is a very well-known conglomerate in the US, so they do make many things, right? Industrial products, so on and so forth. So we just want to give a different types of stocks here for a different flavor. Now, as you can see, if we had only bought let's say General Electric, then after 22 years, the stock would still be underwater. Say it's about minus, 40%. All right, so lost 40% in the last 22 years. So that's not a good idea. So of course, if we have not just bought General Electric, but we maybe have bought a little bit of the STI index through an ETF, then of course the ups and downs would have evened themselves out. Now, this is an example which I can illustrate. If you look at the chart between the years, let's say the middle of 2015 to the middle of 2018, all right? So somewhere on the right-hand side, as you can see, the middle of 2015, the red color line starts going down, but the blue color line starts going up, or rather continues going up. Then as we come down to, let's say, 2017, the red color line goes up and the blue color line goes down. Now, this is exactly what we want, because the weakness in the STI index is made up by the performance in General Electric. And then when General Electric drops, the STI index continues going up. This is exactly the whole point of diversification. You don't want the different stocks to move exactly at the same time, because if everybody makes money at the same time, everybody will drop at the same time because they are roughly similar stocks. An example, of course, will be in the Singapore stock market. You don't buy DBS, OCBC, as well as UOB, right? Because they're all three Singapore banks. They've got roughly the same type of business model, the same type of risk factors, right? So you don't buy all three. You just choose two or one, right? So because they're roughly the same thing. It's just like buying vanilla ice cream from Haagen-Dazs as well as Ben & Jerry's. It's mostly, it tastes the same. So why don't you just buy vanilla and chocolate rather than two vanilla ice cream from different companies, right? So that's the whole point of diversification. And of course, if you do add in Disney, then Disney, of course, will behave quite differently from the rest of the stocks as well. And of course, nearing, or rather after 2013, as you can see, Disney has performed very, very well. Okay, I'm just checking my time here. All right. Next. So the idea is that you want to diversify. Okay. Now, number three, the third point that we want to discuss today is, of course, let's talk about a human life cycle here. All right. So for the first 25 years of a person's life, generally this person is, doesn't add anything to the economy. So this person is generally growing up, having an education, so on and so forth. So obviously, if you're a lady in Singapore, you don't have to do national service. So you might finish your education or your tertiary education earlier than the guys, right? But generally, let's say just to make it simple, the first 25 years, they don't contribute anything. Then you have got the next 40 years. So the next 40 years, obviously, if you join the workforce, then in all likelihood, you'll be working for somebody else, all right? You'll be gainfully employed, all right? They pay you a salary and you slog for them, all right? That's 40 years. Then, of course, once you hit, so 25 plus 40, that's 65, right? So that is retirement. So after retirement, you can enjoy your days watching Korean drama series while taking care of your grandkids. Basically, you are an unpaid babysitter. And that will be, of course, the last 20 years, because statistically speaking, Singaporeans, we will generally kick the bucket in our mid-80s, all right? So for guys, we generally live until 82, 83. For ladies, I think it's 2 years more, maybe about 85. So I think that's actually a good deal for Singaporean women, because Singaporean women don't have to do national service, so they save 2 years, and they live 2 years more, so that means they got 4 years in front of the guys. It's all good, so don't worry about that, all right? But as you can see, the middle part, the 40 years between the age of 25 as well as 65, that is the most productive point in a person's life, all right? So you're going to be working, you're going to have income, and you're going to be saving some money, all right? And again, the last thing here I want to say is, of course, once you hit 85, statistically speaking, that is the time for us to basically give over, all right? Okay, now let's talk about the productive years. So after the age of 35, enter the workforce. So this is, young adulthood, joining the workforce. And what are the characteristics of, people in this age group? Generally, you've got few responsibilities, little liabilities, as in, not much debt. Actually, that depends on how much you zap your credit card, whether or not you upgrade to the latest iPhone every year, so on and so forth. But again, you're young, 25, generally no kids, no house, so no loan. All right, and you have another 4 decades of working life until you hit retirement. You have got relatively small amount of money at risk. Why is that? Because your income is relatively low. So let's say you make I don't know, $3,500 if you join a Singapore bank. You give some money to your parents, you put CPF, put some money away for CPF, that's mandatory, and then you consume some. So maybe you can set aside $500, let's say, assuming $500. And then you take $500 and you invest in, let's say, I don't know, Tesla, right? And then Tesla might drop 30% in 1 week, I don't know. But the thing is this, it's only $500. So even if you lose everything, it is only $500, right? It's not $5,000, it's not $50,000, right? So it's relatively a small amount of money at risk. And of course, there's 4 decades worth of working life. So even if you lose a few $100 here, a few $1,000s there, in 40 years, you can definitely make it back. And of course, your working life, your career in 40 years is not static, right? After all, you'll be promoted, you get more money, you have a bigger office, people reporting to you, head of department, whatever. So after 4 decades, you're going to get promoted and your salary will be relatively higher. Okay, so it is possible for young people to absorb their losses simply because they have a lot more time compared to the old dinosaurs like myself to kind of make up for the losses. And of course, this guy is not really part of the conversation, but never mind. Now, the idea is this. We want to talk about life cycle investing. So you've got 2 diametrically different segments of the population. You've got young and old. So however you define young or old doesn't really matter. But in general, young people, because of all the reasons that we discussed just now, young people have got the ability to take more risk. And they should, right? Because if you start investing in the more risky kind of asset classes like stocks, then of course you can also invest in the more cyclical type of stocks like technology, biotechnology, financials, consumer discretionary, or commodity stocks. Then obviously it's more risk, but over time you're going to be repaid by higher returns. All right, and you can compound that for the next 20, 30, 40 years, right? Because you start earlier, you can absorb more risk, you invest in the slightly more risky stuff, then of course you get to enjoy higher returns over 40 years. Now, of course, for a more matured person, that is no longer possible, especially if you are retired. So if you are retired, you have another 20 years to go, but you don't have any more salary. So which means that it is a lot harder to absorb losses. So for this category of people, then of course, based on the life cycle, this kind of investors generally should invest in less risky asset classes. So there will be things like high quality bonds. What is an example of a high quality bond? Well, a bond from SIA, that's really high quality, or a bond issued by GIC, Temasek, LTA, HDB. Those are really high quality bonds because there's a very, very small chance of default. So which means that you're probably, all things being equal, you're going to get your money back, and of course over the years they're going to pay you a coupon payment, in other words some kind of interest every 6 months. All right, but the risk is very low because all these companies are big companies, well known, and of course they could be government linked companies, so which means that the risks are really small. Now obviously, even if you're at age 65, you have another 20 years to go, you might still want to invest in some stocks because generally stocks give you a higher return, help you make more money compared to bonds. All right, but we want to invest in stocks which are generally low risk. So one example will be REITs, real estate investment trust type of stocks. All right, so you've heard of Capital REIT, Capital Mall Trust, so on and so forth. Those are the kind of REITs that we're talking about, or Suntec REIT, for example. Okay, so this is basically the third point. Is it the third point? Yeah, the third point. So depending on where you are in your life cycle, you should think about your risk appetite. If you are able to take more risk, then you should, because your returns will compound faster over time, and you have got more time ahead of you basically to make back any kind of losses. All right. Number 4, there is more than one way to skin a cat. Now, what I mean is that we always hear of things like value investing, momentum investing. You know, we've got ideological arguments over the internet. Of course, you know, value investing is associated with Warren Buffett. Okay, momentum investing is, I guess, whenever there's a bull run, momentum investing will come into play. All right, so there's always an argument about which one is better. Same for dividend stocks versus, let's say, technology stocks. Dividend stocks are generally the less volatile, less risky type of stocks. So although they don't increase in price as fast as technology stocks, but they do give you relatively high and stable dividends compared to technology stocks. Technology stocks may not give a lot of dividends, but then what you lack in dividends, you more than make up for in capital gains. That means the stock price goes up, faster. All right. And of course, the question is which one is better. Now, I don't think these are actually the right questions to ask. It's kind of like arguing with your friend whether or not vanilla ice cream is better than chocolate ice cream, or whether ice cream is better than ice kacang, right? It depends, right? Because sometimes you want to eat ice cream because you want to have a milky flavor. So for example, you just had tom yum soup and then your tongue is burning, you want something with milk in it to neutralize it, why you order ice cream, right? If you order ice kacang, that's not going to work so well because it's just ice, there's no milk in it. But sometimes you like ice kacang, right? Because you have got all the ingredients inside, the jelly and the beans and what have you, the red beans. So it really depends. So same for value investing versus momentum investing. This is really not a good question to ask because we don't want to be ideologically fixated on any one technique. Now, as a point to note, value investing, if you look at Warren Buffett's performance in the last few years, it's actually quite bad, right? Simply because value investing has not been working. Why? Because there has been a bull run in the US, right? So there was a bull run since the great financial crisis because of near zero interest rates. There was a bull run because Donald Trump was elected to the US presidency, and then he deregulated, he removed a lot of regulations, so the capital markets kind of went up. Big companies started making a lot more money, right? So it's a bull run, right? So in a bull run, value investing doesn't work because the whole definition of value investing is that you want to find value in a stock, i.e., you want to find a good stock at a cheap price. But if it's a bull run, there's no such thing as a cheap price. Everything is expensive, all right? So you look at Warren Buffett. I mean, he doesn't understand technology, so he wants to look for value stocks, but it's very hard to find a stock which is at a cheap price because everything is expensive because it's a bull run, right? So in a bull run, you cannot depend on value investing. You have to go to momentum investing, right? That means whatever that has been performing very well, fundamentals are good, may not be great, there's a lot of risk, but it's been doing very well, you just pile on into it. So it's momentum investing, right? Example would be Tesla, right? So Tesla, really the price has run ahead of the fundamentals, but because it becomes a self-fulfilling prophecy, the more people buy it, the price goes up, more people buy it, so on and so forth. So that's a classic example of momentum investing. It is risky, obviously, because after a while, the price will correct, right? But what I'm trying to get at is that there is no fixed time where one is better than the other. We want to be flexible, all right? Again, there's no fixed time when dividend stocks will be better than technology stocks. If you look at the first half of the year 2020, when the circuit breakers first came in and there was global lockdown by most of the countries, people were stuck at home. Which are the companies that actually did well? Netflix, Amazon, yeah, because people had to order stuff from home. People were bored, so they watch movies on Netflix. They can't go out to the cinema, so those stocks did very well, right? Even now, as recently as now, you can see that Netflix has in the most recent earnings call, they have 200 million subscribers. So that's fantastic results, right? So does that mean that dividend stocks are no longer viable? Of course not. They will come back later on, right? So now technology stocks are in the limelight. Later on, dividend stocks might come back. So it's not a question of whether or not one is superior than the other all the time. It's about what phase of the cycle we are in. All right. So always be flexible. Don't have all these ideological fixations in your mind, right? So there are many ways to skin a cat, right? And the last one, number 5, is you kind of need to understand how your mind works, the psychology of an investor, the psychology of the market. Now, if you look at this chart, the red color line is actually the performance of the S&P 500 between the year 2004 and the year 2013. Now, of course, the highlight of this chart is in the middle, between the years 2008 and the years 2010. That's, of course, great financial crisis, right? So what we want to do is basically to tag different adjectives, the state of mind, to different parts of the stock market. So as you can see on the left-hand side, we've got optimism, thrill, excitement, euphoria. This is what the typical investor will feel when the market keeps going up, right? So the first time is, oh, it's optimistic. The market goes up. I made a good deal. I made a right decision. So it keeps going up. Oh, the thrill of making money. I'm going to hold on. The excitement. And of course, when it increases very high, the euphoria. Okay. So after a while, the market obviously has to correct. That's when we get a little bit anxious. That's when anxiety will come in. Then after that, the market keeps going down. We'll go into a state of denial and say, no, this is not happening. The market will correct. I am, very sure about my decision. The market is wrong. The market will come back after a while. The market does not do that. The market crashes further. Of course, fear. After fear will be desperation. Don't know whether to get out. Then there'll be desperation will give way to panic. Capitulation is, of course, I give up. I resign. I don't know what to do. I just want to cry and, go to sleep, right? Despondency is, of course, depressed. Then, of course, once you go past depression, then again, market goes up. Then we'll get back to hope, relief, optimism, thrill, excitement, euphoria. Now, this is the typical cycle of the market, but this is also the typical investor psychological cycle, right? Now, the idea is this. How you feel about what's happening in the market is really up to you. You shouldn't have your state of mind dictated by a price chart on a computer screen, right? For example, yesterday, the S&P 500 dropped close to 3%, right? I myself have lost a bit of money because I put money in Amazon, all right? And Amazon dropped about 3%. And just to be clear, Amazon is at $3,100 per share. So that means 3% is $30 US. Okay, that means I lost about $100 USD per share. Okay, now to be clear, I'm still in the black because I bought it much lower, but I'm now making less money. All right, but I'm not very depressed about it. I'm not even depressed at all. I'm not even looking at the screen, right? And there was a time when I was holding Amazon and it really dropped by $100 per share. That means I was underwater. I was losing $100 per share. I got a bunch of shares out there. And again, I wasn't depressed. I was just fine. Why? Because I know that the market will come back. I know that Amazon is and just to be clear, this is not a recommendation. But if you look at the analyst consensus, Amazon's target price is far higher than its current price. That means it's a fundamentally strong company. So you have got all this whipsaw in the stock charts, the price charts, but I am not particularly concerned, right? Because I know it'll come back. And it does. Same thing for Apple. I bought it at a price. It went down. I lost money. I waited for 2 weeks. It went back up. I made money and I got out, right? And this is actually not particularly difficult. I find that if I make small bets over time, I tend to not lose money. I just wait it out because I know these are fundamentally strong companies. I wait it out. I don't go through this mind games, this thing about anxiety, denial, fear, and all that, desperation. I just wait it out. And after 2 weeks, the price will come back and I'll be in the black. So generally speaking, I make money maybe once a month, but it's a few thousand US dollars. Yeah, and I'm fine with that. This is just spare change. I can use it to go and buy myself a new laptop or whatever. Go for buffet lunches, and that's a problem for my waistline, but that's a separate discussion, right? So what I'm trying to say is that you don't want to have the market dictate your mindset. You don't want to be depressed simply because of the price chart. You don't want to be, giddy with enthusiasm simply because your price went up. This is not good for your mind. All right. So you need to understand the market psychology, and you need to kind of check yourself. So when you're irrationally happy or when you're irrationally depressed, simply by looking at the price chart, you kind of need to take a break, right? Maybe you've been trading too often. Okay, so the right frame of mind. Now, a couple of tips on how you want to get the right frame of mind. Firstly is, don't depend on investing to make money. It's just a game. So again, taking myself, personal experience, even if I lose everything on the stock market, that's fine because this is my trading portfolio. It's not my investing portfolio. So I've got enough portfolio using CPF, using SRS, using other things. That is money that I can't afford to lose. So I buy very safe financial products. So I have got a pot of money that I use to invest in crazy stuff like Apple, Tesla, Amazon. Even if I lose all of it, it's entirely fine. It's entirely fine. And I don't trade every night. Maybe one night I'll make a trade. I don't do anything for the next 3 days because the price is not right. When the market turns, it goes up by a couple of points. I'm in the black. I'll get out. That's $1,000 US in the bank. It's just a game. Even if I lose money, I make money. It's entirely fine with me because I don't depend on a pot of money to pay my rent, or not pay my rent, pay my loan, to send my son to school. I don't need that. That is basically my trading money. So I'm entirely very calm about it. Now that's related to the second point. Invest only what you don't need. If this sum of money is what you need to pay for your home loan, to pay for your food, then you can't invest in this, right? So, invest only your extra money. How do you get extra money? Well, you don't really have to upgrade your iPhone every year, right? Upgrade it once every 3 years. Better yet, you let your wife upgrade and then you get an old phone. Right? That's actually what I do. But anyway, my wife really likes Apple, so she upgraded. So now she's on the Apple iPhone 12. So I'm waiting for her to wipe her data on the iPhone 11, and I'll just take it over. And that's what, $1,200 safe, which I can then go and invest somewhere. All right. So what else can you save? Well, don't use a Grab car. Take a bus, take the MRT, or walk. Right? Don't order food from a food panda. Just walk downstairs to the hawker center and just buy something. I mean, it'll take you, what, 15 minutes? And of course, you get some exercise, but then you'll save tons of money on the delivery charge, right? Okay. So all these are the little things. Every day you save a few bucks here once in a while. Then, of course, after every few months or after a year, you're going to have a pot of money. And this is the money that you have wasted anyway. So this is money that you don't need. And then you can go and buy, I don't know, Capital Land, DBS or whatever, or Amazon, right? So invest only what you don't need. Now, another technique is, of course, works very well for me. I combine both fundamental as well as technical analysis. So I don't actually read research reports, although I'm the head of research and I should, but because there's so many stocks to cover, I can't go through the financial statements for every company. But what I do focus on is the analyst consensus, right? So if most analysts say that this company is a good company, buy recommendation, and the target price is, I don't know, 20-30% higher than the current price, then of course I'll consider buying it. All right. So I have a screener. I filter out all the fundamentally strong companies that have got sufficiently interesting upside potential, and then I pick a few, right? So of course I'll pick stocks that I understand, that I like the business model, I like the people running it, I like the product, so on and so forth. All right. And I don't really go for the small, and I don't really go for the mid-tier or small cap stocks. Right. A lot of investors, especially retail investors, I don't know why, but we like to invest in penny stocks in Singapore. That's not really for me, because the kind of companies, you don't have a lot of research analysts covering them. So that means I have to read the financial statements and I may not know the company very well. So I don't like to invest in things I don't understand. So I basically invest in the well-known companies, right? So that's fundamental analysis. So I want to make sure I'm picking a so-called good company to buy. All right. Now, of course, and then I will use technical analysis to decide when to buy it or when to sell it. So although it's a good company to buy, I don't want to buy at a high point. I want it to drop down a bit. So again, Amazon is a good example because last night it dropped 3%, right? Amazon's earnings is going to come out next week on the 2nd of February. I think it's going to be a good number. So I don't know, maybe I'll pick up more Amazon today, or maybe I'll let the price drop a little bit more before picking up. Again, not a recommendation, all right? But this is just an example, right? So I look at the charts to decide when is a good time to enter a position or when is a good time to exit a position, right? So fundamental analysis to find out whether or not it's a good stock, only focus on the good stocks, and then use technical analysis to decide when to buy and when to sell, okay? Now, the interesting thing is that fundamental analysis is FA, right? Technical analysis is TA, right? If you combine, what do you get? FATA, so that's FATA. I don't know. I think that's quite prosperous, right? That's what a friend told me. But I think it really works well, at least for me. So I am what you will call classically trained. I'm a chartered financial analyst. I worked in a bank as a portfolio manager, as a market strategist. So fundamental analysis is really, my training, but I also do find that technical analysis, or rather the skill sets which are more or less associated with stockbrokers as well as day traders, that skill set, technical analysis, is also actually quite helpful, especially if this is your trading portfolio and not your investing portfolio. So trading portfolio, you just want to hold a stock for a couple of weeks, couple of months. It's not really for years. So that's where technical analysis is actually very helpful. Then, of course, also do understand that you are gonna get a lot of it wrong, right? You think the stock market will go up, but it drops. You think the stock is gonna drop, but it goes up, right? So if you get 60-40, if you get it right 60% of the time, I think it's okay, all right? Nobody gets it 70% or 80% of the time, all right? So that's very, very rare. There are millions of investors out there. Very generally speaking, if you are better than 50-50, I think it's, you know, good enough. So how do you actually manage that? So if you're only slightly better than 50-50, then of course risk management comes into play, because you're going to be losing money about 40-45% of the time. When you are losing money, then of course you need to manage your risk and you need to cut your losses. So cut and run if needed. There's no shame in it, because you want to live to fight another day. The stock will always come back if it is a fundamentally strong stock. If it's a good, well-run company, good business model, it will come back. All right, so you can always cut your losses, come back again when price is on the way up, and you can buy back in. All right, so this is risk management. One specific example of risk management is that I don't like to just buy one stock or one lot, right? I buy multiple lots. For example, I try to buy multiples of 3, like 3 lots, 6, 9, 12, all right? So let's say you talk about 3 lots. Why 3 lots? Because when the market or when the stock price starts going up and I'm in the black, I'll sell the first lot, because then I will cover my costs and I'll make a bit of money, right? If the stock price again continues going up, I'll sell lot number 2. Then I'm going to get more P&L, right? Why do I keep the last lot, lot number 3? Because sometimes the market will go a bit berserk and then the price will surge higher, and then that's, you know, kind of a lucky streak. So if the price actually surges a bit higher, then I'll sell the last lot. Okay, that's exactly what I did for Amazon. So when the price turned, it went up, I sell the first 1/3 of my holdings. Price went higher, I sold the second third. Now the price corrected. The price corrected last night. That's fine. So I'm still holding the last 1/3, but I'm still in the black, right? Even for the last 1/3 and for the entire holdings, I'm still in the black. So at least I sell a bit, I cover my costs, I make some money. So when the market turns, I'm still in the black, right? So try to buy, try to buy your stocks in odd numbers and, you know, multiples of 3, or you can do multiples of 2, right? So you buy half, or let's say you buy 2. When the market goes up, you sell half, you lock in some profit. The second half is, you know, in case the market really chong, then you can make even more money. Now the problem with only buying one lot is all or nothing, right? If the market goes up, you'll be wondering, should I sell now to make some money, or should I wait to make even more money? It's a very agonizing decision. So don't just buy one lot, right? Buy in multiples, because you can always bifurcate your trades, right? So that's one idea on how you can basically manage your risk. Okay. Now this is really the end of the seminar. Very quick and dirty, 5 different points that guidelines that you want to kind of have the back of your mind when you are trading in the stock markets. And do you have any questions right now? If you do, please post it on the the Facebook page, and then the events management team will send it to me. So I'll give you a few minutes. We actually do have another 11 minutes, 7:49 right now. We do have another 11 minutes to the hour in which you can ask questions. Now, as we are waiting for the questions to come in, let me just go through a couple of slides at the end here. We do have a couple of upcoming seminars, presentations, as well as investment chapter series courses. So these are the dates. We've got a wide selection of different asset classes and different themes that the classes actually cover. All right, so most of them, or at least all of them on this page, they vary between 2 hours to 3 hours each. Okay, So these courses will be running from March onwards, and this is the second page running all the way to the end of July. So for the first half of 2021, these are some of the courses we're going to have. Now, for all of you long-time participants of SIA's presentations and courses, you might find that some of these are new. That is really because they are new, and the first time we'll be running it will be in 2021. So it is our mandate basically to widen the types of educational products that we have, basically to make sure that everybody who comes to, or anybody who's a SIAS member or comes to any of our presentations, you get a variety of education, right? So you don't just want to talk about stocks, you also want to talk about bonds and REITs and other stuff. All right. Okay. Now, if you are interested in registering for any of the course, well, you don't have to put in any money. You just want to register your interest. You can basically use this QR code. All right. And again, just FYI, there's a difference in pricing for members and non-members. All right. It's actually worthwhile to sign up as a member because I think it is. I think it's $1 per month. All right. So as you can see, the price difference between a member and non-member is around $15. So if you become a member, it's $12. So you still save a bit of money, I think. Okay. This is again a QR code. This is a QR code for the mailing list. So if you want to get updates on our programming, as well as news, you can get it from here. So we do have a question. How about ETFs? What do you mean by how about ETFs? So ETFs are exchange traded funds. They are actually unit trust funds, which are traded like stock. So they're listed on the exchange, whether it's a Singapore exchange or the New York Stock Exchange. It's basically like instead of going to fund supermarket to buy and sell a unit trust fund, you can and buy and sell it like a stock on the stock exchange. So all you need to do is actually pay for the commission for the stock, just like any other stocks. There are ETFs, unit trust funds, therefore there is an annual management fee, but you don't actually have to pay that extra. That's actually part of the price already. So when you see the ETF is, let's say, $3 per share, the annual management fee is actually covered within that $3 per share. So what you're actually paying for is really the commission. Right, that's the only cost that you should pay for, which you will directly pay for, sorry. And of course, depending on the kind of ETF that you buy, if it's a stock ETF, there are going to be dividends, right? If it's a bond ETF, there are going to be what we call coupon payments, all right? But there are two ways to handle the dividends or coupon payments. Either the ETF sends it back to you as cash, or it will be automatically reinvested. So different ETFs will handle it differently, so it's important that you check the fact sheet for that particular ETF that you're interested in. All right, there are many ETFs listed on SGX, but there are hundreds listed on the S&P 500. Not S&P, but basically the New York Stock Exchange. All right, I think there are about maybe 50 or 60. I think there used to be 50 or 60 ETFs listed on SGX. All right, so a very wide variety. Okay. Next question: how do I select a suitable broker? What to look out for? I think the main thing we're going to look out for is really the platform. Do you like the platform? Right. So you might open a account with a particular local broker, and they give you the access to the platform, and you look at it, you don't quite like it. Maybe it doesn't have the features that you want, or the icons are placed differently, or you don't like the color. Then of course you can open up a different account, right? The accounts from a Singapore broker are free. You don't actually have to pay any money. All right. If you do fund your account, that means you put some money with them. You get a cheaper commission. But if you just want to look see, then you can just open an account without funding it. They just to get access to the platform and to look at the functionality, right? This is very subjective, as in some people may like a particular platform, other people may not like the same platform. So you should check it out, all right? And since local brokers to open a account is basically free, then it's like a credit card. You just open it, right? Just open as many as you want. Then of course, after 1 year, when they come back to you, ask you for your credit card annual management fee, you just tell them to cancel lah. All right, you just try it out first. Okay. And of course, apart from the local brokers, you also have got interactive brokers. You got Saxo Bank, you got IG Market, so on and so forth. So there is a lot of selection nowadays. All right. And of course, the other thing you have to look out for when you talk about broker is, are they licensed in Singapore? Are they recognized by MAS? So if the broker has got a physical address in Singapore, then yes, generally speaking, they'll be licensed by MAS, and then they will have this license number on their website. So do check out for them. If you open a account with a broker offshore, that means it's not protected by MAS, then it's a buyer beware. Okay, and of course the last thing will be the price, the commission. All right, so you can always compare and contrast, or you can just Google it. There are some websites out there which actually has a table to compare all the different prices. You just Google it. There's some people out there that actually track these things. So these are basically the top 3 things that you want to look out for when you're looking for a broker. We do have another question. Besides stocks, what other investments should beginner investors learn? I think ETFs are also going to be quite important, because ETFs has got built-in diversification. When you buy an ETF, you're buying basically all the component stocks which are part of the ETF. So for example, if you buy the STI ETF, you're buying all 30 stocks of the STI index. If you buy the S&P 500 ETF, you're buying all 500 stocks of the S&P 500 index. All right. So you have got built-in diversification. So ETFs are actually very exciting. I personally believe in ETFs. The other one will be REITs, real estate investment trust. Those because those are actually, they give relatively stable dividends. Not in 2020 because of COVID-19, but apart from COVID-19, prior to the year 2020, they actually give quite stable dividends. So they are very viable as a dividend yield stocks. All right, so that will also be quite interesting. All right, we are going to have an upcoming seminar on fixed income. That means bonds. I think a lot of the Singapore retail investors don't actually understand how they work or where they can buy those. So I think those would be bonds as a asset class could also be quite interesting for beginners to understand. Okay, next question. What is 100 shares versus 1 lot shares? Yeah, that depends on the market you're talking about. For example, on SGX, 1 lot is equal to 100 shares. 1 lot equals to 100 shares. In the US, there's no such thing as lot, because you can even buy fractional shares. That means you can buy 0.35 of 1 share. All right. So it really depends on the platform that you're using and the market that you're talking about. All right. Now, the challenge with the Singapore market is that a lot of penny stocks, well, they're called penny stocks, right? So it could be 0.5 cents per share. So of course you cannot buy 1 share, you buy 1,000 shares or 100 shares, sorry. So you just tell the broker I want 1 lot, so that will be equivalent to 100 shares, and each share is worth 0.5 cents. All right. So that's why we use the lot system, simply because in Singapore the share prices are relatively cheap. Not so in the US. In the US, again, taking Amazon as an example, 1 share itself is north of it's about $3,200 US, 1 share. Okay. Obviously, if you buy 100 shares, that will be a lot of money. Yeah. Next question: Can I have a view of your view of the ARA Logos Lock Trust? Don't really want to answer this question because we are not really in the business of giving a recommendation or viewpoint on particular stocks. So today's presentation is really about the some things that investors to look out for. Don't really want to comment on any particular stocks. Similarly, for the last question, is Singtel an undervalued stock? Don't really want to talk about that. I would probably say that you might want to look at the analyst consensus. All right, so you could read all the different research reports to find out what the recommendation is or the target price. But obviously, if you read, let's say, 5 different research reports from 5 different brokers, they might give you slightly different target prices. They might also give you slightly different what you call recommendations. So what you want to do is to find an average, right? That's where the analyst consensus comes in. All right, you can try to Google that as well. There is actually a local, not a local broker, but there is actually a broker which is licensed by MAS, in which their platform gives you the analyst consensus, yeah, for free. That means when you open the broker platform, right, you have got all the list of all the stocks, right? One column, right, analyst consensus and target price, right? Not gonna tell you which one, simply because again we are SIAS, we want to be impartial, we don't want to recommend any broker, so on and so forth. But this is FYI. You can obviously go and Google it yourself. All right. Our next question: if I have odd lot of shares, 63 shares, how can I sell it off? Yes, you can. You can always tell your broker. Okay, so you've got 63 shares, right? One lot is 100 shares. Okay, so you have to go and sell it in the odd lot market. There is what you call an odd lot market. That means anything which is not multiples of 100 shares, you can sell it in the odd lot market. But the odd lot market is not something that you can actually do on the platform. You probably have to call your broker. Okay, you call your broker and say, I've got 63 shares on a sell. Now, the problem with an odd lot in the Singapore market, right, is that if people know you have an odd lot, then of course, they know you're stuck. So which means that the price you're going to sell is not going to be a good price because they know you are desperate, right? So that is the challenge of the odd lot market. I'm guessing you have an odd lot simply because of rights issue or because of what, stock dividend, right? I'm sure you wouldn't have called your broker to say, I want to buy 63 shares. So this is probably an outcome of a rights issue or what have you. I would suggest that you just bite the bullet and sell it off, because it's you're always gonna have to sell it at a discount because it's at the odd lot market, right? Okay. Next, what platform would you suggest to trade US stocks? All local brokers have offer access to the US markets. I would highly suggest that you check the commissions. All right. In the interest of full disclosure, I would also point out that you also have got foreign brokers in Singapore, right? So you've got companies like Citibank, they do offer a brokerage platform. You also have got Interactive Brokers, Saxo Bank, IG Markets. Those are the foreign brokers, but they are licensed by MAS because they're physically in Singapore. You should check the brokerage between the local brokers and the foreign brokers. There is a difference. Okay. Again, this is something that I wouldn't want to show favoritism or any kind of recommendation, but I'll just point out that there is a difference in the commission rates. All you need to do is Google it. Just 5 minutes and you'll know how much a foreign broker charges for US trade versus a local broker. You'll be astounded by the price difference. Okay, and that is all the time that we have for because it's already 1 minute past 8. So I would like to thank you on behalf of the CRS team, myself, as well as our event management team, which are working in the background to set up all this infrastructure, as well as to post me the questions from Facebook. On behalf of us, thank you very much for joining us this evening. All right, and also be sure to zap the QR code if you want to be on our mailing list. So thank you and have a good evening.